Hello and welcome back. This is Adjusting Entries Part 6, Sample Problem, Initial Entries into T Accounts, Unadjusted Trial Balance, Adjusting Entries, and the Adjusted Trial Balance. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation or the other parties. Rather, the other parties are their owners of their respective copyrights. So right now we're going to go through and we're going to do a comprehensive problem. And this involves everything we've been going over in the other videos. And so I'm just going to pause momentarily as we jump to our next screen. So we have here Internet Express, who started business on January 1st, 2018, and had the following transactions. So the first part here, and when we go through and we do adjusting journal entries, the first thing that we're going to want to make is a unadjusted trial balance, just to make sure our total debits equal our total credits. So I'm going to go through this rather quickly. If you want to go learn how to do any of this, I want to go back and encourage you to look at my previous videos. So here we've got January 1st, Smokey and Bear each contribute $50,000 cash, while Turtle contributes a machine valued at $100,000, all in exchange for common stock. So here, common stock, there's cash of $100,000. Why is it $100,000? Because Turtle and Bear are each contributing $100,000, while the other character is giving us equipment. Smokey and Bear, excuse me. Smokey and Bear each contribute 50, so that's $100,000 cash, while Turtle contributes a machine valued at $100,000. Debit to equipment here, credit to common stock. And this is transaction A. Letter B, I purchased an insurance policy that will provide coverage from May 1st, 2018 through April 30th, 2019 for $36,000 cash. So this will be transaction letter B. This will be a debit to prepaid insurance and a credit to cash. Snake hires us to provide services. Snake will pay us $10,000 per month for 2 years beginning on June 1st. We receive an advance of $30,000 cash for the services on June 1st. This is going to be unearned revenue. I am receiving money and I have not yet performed the services. And again, I'm not going through the explanations on this. At this point in time, these initial entries should be very easy for you to go through and do. Please look at the prior videos if it's not making sense. Right here, letter D, I'd make no journal entry. And the reason why is I'm hired Gander as a contractor to assist us. I will pay Gander $2,500 per month for 12 months beginning on September 1st. All I've done is I have signed a contract. I'm not going to make any kind of entry at this point in time. So first one though here is on September 30th, I receive an invoice from Gander. Now that I've received an invoice and Gander has performed those services for us, I'm going to be debiting consulting services expense. For $2,500. And I'm going to credit accounts payable for $2,500. Why am I doing that? When they invoice me, I haven't really done anything yet. They're invoicing us $2,500 on September 30th for services rendered. I haven't paid them. Like similarly, Gander is giving us $2,500 or giving us an invoice for $2,500 for services rendered. And this relates to this contract up here in letter D. So this is going to be okay. So it's E and F. Notice here we are not doing any adjusting journal entries. We first need to do this part. So here, IEI pays Gander $1,000 on November 1st on the invoice in letter E. So what I'm going to do here is I'm going to decrease my cash. And then I'm going to debit accounts payable for the 1,000. Again, if this is not making sense, please go back and see the other videos. Depending on where you're taking me for accounting, if you're taking one of my classes where you're meeting 2 hours and 15 minutes per week, you would have to go through and do everything here. If you are taking a class with me that only meets an hour and 15 minutes per week, I generally give the unadjusted trial balance. Here we've got IEI pays Gander $1,000 on the invoice in letter E. Letter H, Jackson loans us $100,000 on November 1st. The loan and interest will be due in 1 year. The loan has a stated rate of 12%. So right here, I'm receiving $100,000 from Jackson. And for every debit, I need a credit, and that credit will be to loans payable. And I believe that that was letter H. Okay. And then over here, we loan Hans $20,000 on December 1st. So if we're giving money to somebody, our cash is going down. And we will be debiting a loan receivable. And lastly, I pay a cash dividend of $4,000 on December 20th. So my dividends, debit for $4,000. And I'm going to credit cash over here for $4,000. Okay, so that brings us to the conclusion of putting in these initial entries. And what I'm going to do right now is do my unadjusted trial balance just to make sure that my total debits equal my total credits, and I will be right back. Okay, and we're back. And so I have here my unadjusted trial balance for IEI. And this is as of 12/31/18. I'm not really concerned with the formatting of my unadjusted trial balance. If you have an instructor that is concerned with the formatting, I suggest you have them open up an SEC file and tell me if you can find one. If you can find a trial balance on an SEC file, I'll buy you a cookie. So the next thing we're going to do here is the first step is we've gone through and we've input all of the transactions into the T accounts, and then we're making sure that our total debits equal our total credits, which is what I've done here. Our next step is, as we look at these transactions, and this is really the purpose of you watching all of the previous videos, is that we need to understand when we're going through and creating when we are preparing our financial statements, I'm asking myself 4 questions. Do my assets reflect the future economic benefit? Do my expenses reflect the use of those assets, or do the expenses reflect what I've used? Do my liabilities reflect my future obligations? And lastly, do my revenues reflect what I've earned for the period? And with the expenses is really, does it reflect really what I've used for the period in terms of if someone's provided me a service and if I not yet recorded that. So the first thing we're going to do here is that, and I'm telling you here, which is the transactions that initiate with letters A, B, C, D, H, and I all require entries. What that means is you would need to do an adjusting entry for each one of these items here. And again, if you've watched the previous 5 videos, this should hopefully give you a pretty decent clue. So the first one is going to be is that when I received the equipment and I see this additional information here, what I need to do is, because I'm getting this equipment on January 1st, or this machine on January 1st, I'm using it for the full year. So as part of that use, I need to go through and record the depreciation expense. So to compute the depreciation expense, I'm going to have my acquisition cost minus my salvage value divided by my estimated useful life. And again, if this looks not familiar to you, I want to encourage you to watch the previous video that covers the depreciation. So here my acquisition cost was $100,000, or the value of what I received or gave up in stock to Turtle, minus the salvage value of $20,000 divided by 4. So this is going to give me $80,000 divided by 4, or $20,000 of depreciation expense per year. And just note really quickly, because we're getting this asset on New Year's Day or January 1st, it's not really realistic, but it helps us here. I would just multiply this here by 12/12 because it's a full year, or 1/1/18 to 12/31/18. And so my full depreciation expense is going to be here at $20,000. So when I go to record depreciation expense, the way I'm going to do it is going to be, and let's just write up here a little T account. My assets equals my liabilities plus my owner's equity, ERDC. So right here, when I record this depreciation expense, I'm going to do so with a debit. We're going to call this A1 because we're adjusting the letter A transaction. By the way, if you take my class and if you do your little numbers here, much easier to grade your test. But here, for every debit, I need a credit, and the journal entry I'm always going to be using to record depreciation expense is going to be a debit to the depreciation, and then I'm going to be crediting accumulated depreciation, which is what we call a contra asset account. Okay, I do not directly credit the equipment up here, rather I use this contra asset account. So again, want to encourage you to look at the prior video. So that was letter A. So we're done with letter A. Letter B, I purchased an insurance policy on May 1st that will provide me coverage for 1 year for $36,000 cash. When I look here at my prepaid insurance policy, this was really my balance on, this happened to be like my balance, I want to say it was on May 1st. And that was May 1st. Now we're at December 31st. And so kind of the challenge for us is, do we still have $36,000 worth of insurance coverage? And the answer is no, because this $36,000 was for 12 months, and now some months have gone through and expired. So what we need to do is we need to determine the amount of, the remainder, or how much we should actually be going through and expensing. So here's what we're going to do is we're going to say, okay, my total, basically total insurance policy was $36,000. Months of coverage was for 12, because that's what it tells me, May 1st through April 30th. So my amount of my insurance expense per month is going to be $3,000. And just to kind of, so this again, this is 12 months of coverage, or May 1st through April 30th. And so the cost of or that insurance expense I'm going to be recognizing is going to be around $3,000 per month. Now, how many months have I used the policy for? We do the accounting bird box challenge. We close our eyes and we count on our fingers: May, June, July, August, September, October, November, December, or 8 months. So here I'm going to multiply this by 8. I should say 8 months. So here, this is going to be from May 1st through December 31st. So my total amount of my insurance expense for 2018 is going to be $24,000. So how do I record expenses? I'm going to show this here as a debit for $24,000. And if you've watched the video on this, what I do with insurance expense is I'm going to be crediting prepaid insurance. So here I'm going to credit prepaid insurance for $24,000. Now, notice here that when I have my ending prepaid insurance balance, it is $12,000. Remember what we said, our expenses need to reflect the use of what we had in the period. The assets or our prepaid insurance need to reflect our future economic benefit. So right over here, as I'm looking at this question, does this $12,000 reflect our future economic benefit? And the answer is yes. I have remaining coverage from January 1st through April 30th. So that's January, February, March, April, or 4 months. That 4 months times $3,000 per month is $12,000. So that's how I know I have gone through and at least done this part of the question correctly. Okay, I now go to my next part here, and it says letter C. So let's take a look at letter C. So Snake hires us to provide services. They're going to pay us $10,000 per month for 2 years, beginning on June 1st, and they give us an advance of $30,000 cash. So the way we recorded this transaction is that we debited cash and we credited unearned revenue. But if we notice here, we did not invoice Snake at all during the rest of the year. They hired us, they gave us 30 grand cash, but we didn't do anything else. So what we need to figure out in terms of what do we actually do is we need to say, okay, have I been performing work for Snake? The answer is yes. How many months of work have I done work for him? So let's figure out. So C, here we want to make sure that our revenues reflect what we've earned during the period. So here, Snake hired us for $10,000 per month. And this here was for 7 months, or June 1st, 2018 through December 31st, 2018. That's 7 months, count it out. June, July, August, September, October, November, December. So the total revenue that I should be recording should be 7 months times 10,000 per month, or for a total of $70,000. So right over here, I'm going to be recording revenue. And again, remember with revenue, it does not matter whether I have been paid or not. Okay. So now my question to you is, okay, he's paid me $70,000, or excuse me, let's take that back a second. I've recognized revenue of $70,000. How much money does he actually owe me? And as we're looking here in terms of the various different accounts, One of the things that happened earlier is that he gave us a cash advance. We debited cash and we credited unearned revenue. And so now what I'm doing over here is that I'm crediting revenue for 70,000. So this is my this is unadjusted, and this is my adjusted entry. So for this part right here, if I'm recording this revenue here of $70,000, how do I go about and make the adjustment? Okay, so right here, I have a credit to revenue. On my books already, I had a debit for 30,000. What I'm going to do here is that this revenue is no longer unearned. I've actually gone through and earned this revenue. So what I'm going to do, we'll call this C1. This is transaction C. So the first part of my adjusting entry is going to be to debit this unearned revenue. And why is that? Well, this really served as a prepayment for services. And this was really for 3 months, or if I'm charging 10,000 per month, the amount of the advance is 30, it's for 3 months. So this was really meant to cover for June, July, and August. Okay, so as those months have passed, what I need to do here is I need to debit my unearned revenue for $30,000. At the same time, though, does my adjusting journal entry balance? The answer is it does not. What I need here is I need another debit for what I need here is another debit for $40,000. And what is this debit going to be to? This is going to be to accounts receivable. And the reason why it's going to be accounts receivable is because if we think about this intuitively, I performed $70,000 worth of services. I got a cash advance from Snake of $30,000. So this $40,000 is the amount owed from Snake, and this is going to be our account receivable. So that's how we kind of go through and deal with this. I created a similar question earlier on. This is a little bit different because we're not actually we earn through part of it and we have this remainder, but that's kind of the concept behind this. So again, with this one particular question, I kind of start with how much did I actually earn? Here I worked for 7 months, and so I should be recording revenue of $70,000, or from June 1st through December 31st. At the same time, when I look at the other side of the equation, this unearned revenue that I recorded has now been earned while we've performed those services. But at the same time, Snake still owes me money. So that's really going to show up here as an account receivable. So what we're going to do here is we're going to debit the unearned revenue, or that C1 here. This is now going to have a 0 balance. And then the next part I'm going to be doing is I'm going to be debiting accounts receivable, which I'll just make up this right here. For 40,000, and this will also be on transaction C1. And then I'm going to be crediting revenue here from transaction C1 for $70,000. So that is transaction C. Okay, so now we go to transaction D. So here I hired Gander as a contractor to assist me. I will pay Gander $2,500 per month for 12 months beginning on September 1st. So let's kind of take the same approach on letter D as we just did on letter C. This is kind of the opposite, where I'm hiring someone to do work for me and I need to pay them. So for letter D, when I kind of think about it, how much do I really need to have here in terms of expense? So my consulting services expense for the period should be from September 1st through December 31st, or 4 months, September, October, November, December, times $2,500 per month, or totaling $10,000. So when I come over here and I'm looking at my consulting services expense, my ending balance in terms of consulting services expense should be $10,000. So this is my ending balance for consulting services expense. Now, what makes this question a little bit different is that, well, I actually received invoices from Gander, and I received two $2,500 invoices, and then I did not see one again. So I have a balance in here of $5,000. What do I need to do to adjust how do I get from 5 to 10,000? Well, here, this is going to be for letter D, and my adjustment here will be for $5,000. Okay, so for every debit, I need a credit. When it comes to Gander here, what we also need to be aware of is the letters E, F, and G. So when it comes to letters E, F, and G, how much have I paid Gander so far? Well, I paid him $1,000. So how much do I owe Gander? Well, it's $10,000 for the services, less the $1,000 payment, and the total amount owed to Gander is going to be $9,000. So when I look over here at accounts payable, if I credit accounts payable here for $5,000, what happens with my accounts payable? Well, my accounts payable had an ending balance of $4,000. I'm making the adjustment right here for $5,000. And so my ending balance here for accounts payable is going to be $9,000. And so with this one adjusting entry, have I gone through and now shown that, oh, well, for the entire period, our consulting services expense was $10,000, which is correct. That is the correct amount of expense. Is my correct amount of expense or is my correct balance in accounts payable $9,000? Yes. Here they owe, or we owed them $10,000. I paid them $1,000, so the amount that I owe is $9,000. So as I look at this, but is my adjusting entry for $10,000 and $9,000? And the answer is no. I want to calculate the correct ending balances, and then I need to see what's in the account. And here, as Gander had gone through and invoiced us previously, I don't need to make that full adjustment. Okay, so that is adjusting consulting services expense. I also have another video out there that focuses on that as well. Okay, so letter H. Okay, so we're almost through. Letter H, Jackson Loans. Wow, good job, Tchaikovsky. Jackson loans IEI $100,000 on November 1st. The loan and interest will be due in 1 year. The loan has a stated interest rate of 12%. So right over here, and this is letter H. So I received a $100,000 loan on November 1st. And let's put this, we'll make it a little bit easier for us. Letter H. Okay. So when I borrow money, and if you notice all of our previous examples all had for the last segment, they were all on December 31st, but now this is November 1st. When I borrow money, I have to pay interest. And so the way we're going to do this is we're going to calculate interest expense for the period of time that we borrow the money. But first, we need to figure out what was the amount of interest for a year. Whenever you see an interest rate on my problems, it is an annual rate of interest. So the loan amount is $100,000. The interest rate is 12%. So the annual interest is going to be $12,000. However, though, this is for a period of a year. How long did I borrow the money for? In this case, it was only for 2 months, or from 11/1 through 12/31, 2 months. So what I'm going to do is I'm going to multiply this here by 2/12. And when I multiply this by 2/12, I'm going to get $2,000. When I borrow money, my journal entry is always going to be the same. I am debiting interest expense. And then I am crediting interest payable. Okay. So that was the letter H. So letter I am loaning $20,000 to Hans. And so similarly here, I'm debiting, so the original transaction is I debit loan receivable and I'm crediting cash because I'm giving them money. Even though Hans is not paying me, I have really earned some interest on this loan from an accounting standpoint because time has passed. So here, the loan amount is $20,000. The interest rate is going to be at 6%. So the annual interest is going to be $20,000 times 6%, or $1,200. So as I look at this right here, this is my annual interest. Have I loaned this money out for a year? No, it's only been for a month. So it's really from 12/1 through 12/31, or 1 month. Remember, this amount is the annual amount of interest that I am to receive. So here, I'm going to multiply this by 1/12, and I'm going to get 1,200 times 1/12, or it'll be $100. So this is going to be my interest revenue for 2018. Okay, so I'm recording this $100, and how do I record it? Well, if you watched the other video, I'm debiting interest receivable, and then I am crediting interest revenue. Now, what do I do at this point in time? What I'm now going to do, and notice, by the way, did I do anything with cash? You never, ever, ever touch cash when you are doing adjusting journal entries. So here what I'm going to do is I'm going to total up my new balances. Here I've got a balance in prepaid insurance of $12,000. Unearned revenue is now 0. Consulting services expense is now 10. Payables is 9. Loans receivable, loans payable, and dividends have not changed. Depreciation is now 20,000. My accumulated depreciation on the equipment is 20. Insurance expense is 24. Revenue is 70. The interest expense here is 2, and then my interest payable is 2. My interest receivable is 100. Interest revenue is 100, and my accounts receivable is 40,000. So what do I do here? Well, we'll see we'll sometimes see formatting where they will actually go through and show you the adjustments with a debit or a credit to get to the adjusted. I like to just kind of cut to the chase, and so that's what we're going to do right here. Now let's just go through these problems. I'm sorry for doing this with you here, but I think you'll find it helpful. So here my cash balance has not changed. My prepaid insurance balance is now 12,000, because remember what happened here is I recorded some insurance expense. My unearned revenue is now 0 because I recognize that revenue. But here, my consulting services expense is now 10,000. My accounts payable is 9,000. My loan receivable, my loan receivable, my loan payable, and my dividends have not changed. For my expenses, I now have depreciation expense on an adjusted basis was $20,000. Accumulated depreciation, this is really the main reason why I'm doing this with you. Over here, my accumulated depreciation balance has a credit. So this is going to be showing here, my equipment carries over, my loan receivable carries over. So here, my accumulated depreciation on that equipment is going to have a credit balance because it is what we call a contra asset account. So that's kind of how that part of it there is going through and working. And let me just bring over this other loan payable balance and common stock because those will not change. My retained earnings is still 0. My dividends are still 4,000. Okay, so my next one here is insurance expense. So my insurance expense was 24,000. My revenue was a $70,000 credit. I had interest expense of 2,000. And then I had interest revenue of over here of 100. And as I'm looking at this here, I want to make sure that I got my loans payable. I have interest payable, which is a liability. And I should have also have interest receivable, which is going to be over here at 100. Okay, so what I do now is I go through and add these up. Uh-oh, I don't balance. No, what do I do? Well, let's go check this out. So here I have, okay, this is a great exercise where I screwed something up, so let's check it out. So my cash is good. My prepaid insurance is now 12,000. My loan receivable hasn't changed. I have interest receivable on that loan of 100. My equipment is still 100. My accumulated depreciation is still going to be, is 20,000, which is what I calculated here below. My accounts payable is 9,000, which is from right here. My unearned revenue is now 0. My loans payable hasn't changed. My interest payable here is 2,000. That's still going to be the same. My dividends carried over. My common stock was still the same. My revenue, my expenses. And let's see, what else am I missing here? Got my consulting services expense. Let's just check these formulas one more time. All right, and let's just kind of see what this difference is. Differences, oh, I know what I forgot. Wow, Tchaikovsky, good job. I forgot to include accounts receivable. See, everybody, I make mistakes too, but this is why this is fun, because I get to make them on video and you get to suffer through them. Okay, so now that I included accounts receivable, I have 401,100. Notice here is that when I'm doing my balance sheet, I'm still following, or excuse me, my trial balance, I'm still doing assets, liabilities, equity, then the dividends, revenues, and expenses. The one thing I'm doing slightly different here is you're noticing a little bit of a break between receivables, here accounts receivable and loans receivable, and then the equipment. And the reason why is later on, we're going to be preparing what is a classified balance sheet. Why did I put loans receivable a little bit differently here? Because when I look at the wording for loans receivable, the loan will be due in 2 years and bear interest at 6%. This loan, as far as we're looking at it, is going to be a long, or essentially a non-current asset, because we're not getting, it will not be paid back to us on December 31st, 2018. Similarly, when I look at the equipment, this equipment is giving us useful life over a long period of time. And so that is why right here, I'm kind of putting this separately with the other assets. So remember that when we get to the balance sheet, we're going to have to create a classified balance sheet, meaning that we are segregating our current versus non-current assets and liabilities. And so I'm starting to make that adjustment over here when I'm doing the trial balance. So that is our video for today. Thank you for bearing through my mistakes, as we all make them. And I think it's kind of more fun to see that I can screw up too. I probably, looking back on it now, I should have just determined what the difference was instead of going through and checking. But we all learn from our own mistakes. So have a great one. Please, if you have any questions, please feel free to give me an email. And thank you for liking and subscribing. And sorry, Anthony, I do not have any prizes or cookies for you. Just great videos so you can do better on my tests. Have a good one.